I'm about to show you the most efficient way to generate passive income, not just in 2022, but in the history of the world. My name is Crypto Noah, and I'm back with another fire video trying to bring you the highest quality crypto book reviews and day in the life content on the internet. So please consider dropping a like, comment, and subscribing, as it really helps to boost the channel. So if you are a person who's been interested in passive income, but you're not really sure where to start, where to look, I'm going to show you exactly how I'm generating $1,000 per day through yield farming. And I'm going to break it down for you step by step. I'm going to go over what yield farming is, why you should be yield farming right now, yield farming risk. I'm going to show you how to set up a yield farm. I'm going to show you my live farms generating me money, whether if I'm out and about, sleeping, taking a shower, or whatever. And finally, I'm going to show you how to track your gains. Okay, so this is going to be one of the most important videos that I've ever made, so I highly recommend you take some notes and really pay attention and refer back if you need to. So without further ado, let's hop into it. So before I get into what yield farming is, there's something very important that you should know. When it comes to generating money in the financial space, there are three main ways that you can generate money as a company. And this isn't including trading, options, derivatives, and all that stuff. I'm talking about just fundamentally. Those three things are fees from borrowing and lending, swap fees from trades, and fees from insurance premiums. And that goes in traditional finance, and that goes for crypto as well. And in crypto, anything outside of that is mostly through token inflation, meaning you're yield farming, but the profits is coming from the project creating more tokens out of thin air. So it devalues your savings, just like with the US dollar. So the two main ways that I like to yield farm is for the first two that I just went over. That's loaning your capital out to help facilitate borrowing and lending, and using your capital as liquidity on decentralized exchanges. Now, what we're going to be covering today is the second one, providing liquidity on decentralized exchanges. So before I go into what a decentralized exchange is, I want to cover how liquidity is gathered on traditional exchanges so that we can have a market to trade back and forth with between assets. So to help you understand this, it's best to view an exchange as a market, a farmer's market. When you go to your neighborhood farmer's market, you expect them to have goods for you to purchase while also having cash to give you if you want a refund, right? It's the same thing with an exchange. You want to be able to trade your cash for the assets you want to buy while also being able to trade your assets for cash. Now, in order for this to work, someone has to take on the risk of buying the assets offered for sale on the exchanges, essentially creating a market. Now, there are companies that create markets for exchanges, and they're called market makers. So let's cover the concept of market making and go over how liquidity is provided on traditional exchanges versus how it's provided on decentralized exchanges. So liquidity on traditional exchanges is defined as large amounts of assets for investors to be able to purchase without the exchange running out. Now, this liquidity comes from large brokerage houses like Fidelity, Citadel, etc. And they essentially create a market by buying extremely large amounts of assets that the exchange wants to sell. And then they use their inventory to fill buy and sell orders so that they can profit from the trading fees. It's not the exchange buying the asset, allowing people to trade. It's the market makers with the deep pockets. Without market making, there wouldn't be enough liquidity to handle trading demand. And now through yield farming, you can actually act as your own market maker. So now that you understand what a market maker is and how centralized exchanges gather liquidity, let's talk about what a decentralized exchange is and how it gathers liquidity. So traditional crypto exchanges such as Coinbase, Robinhood, and Gemini are operated by companies that all have market makers. They utilize these market makers to buy the crypto assets and create a market that allows the public to buy and sell while charging them trading fees. Now, in this scenario, the exchange and their market makers are making all the profits. However, decentralized exchanges, also called DEXs, function by allowing everyday people like you and I to serve as the market makers, allowing us to deposit trading pairs into liquidity pools and get paid swap fees from the buy and sell orders. So just so you know, DEXs were created to allow peer-to-peer trading without the need for any central authority to oversee and authorize trades. And the coolest part about DEXs is that they operate purely from smart contracts and not a company, which means there aren't any salaries to pay, resulting in the market makers, you and I, making higher profit margins from the trading fees. And I'm going to let you in on a little secret that no one's talking about. Traditional banks and mainstream financial institutions are legally not allowed to provide any liquidity on decentralized exchanges. So, and just so you know, people are not only borrowing billions of dollars, but they're also trading back and forth billions of dollars within crypto. So if there isn't any market makers providing the liquidity to help facilitate the borrowing and lending or to help facilitate the trading fees, who's providing the liquidity? Everyday people like you and I. So that means we have higher trading fees that we get to make, given that all of this is governed by smart contracts and not brokers that have mouths and kids to feed. Another thing that's very important, yield farming will probably exist in this capacity for another 2 years because eventually mainstream banks and institutions will be granted the regulatory green light to provide liquidity in crypto, and they're licking their chops at it because they're investing into treasury bonds, not even getting a yield that can outpace inflation. I'm about to show you how you can get triple digit yields within crypto. So the faster you can learn how to yield farm and be a pro, the faster you can start accumulating your favorite crypto assets and stablecoins at a rapid clip before prices explode in the next bull market and before institutions are allowed to provide liquidity within DeFi. So now let's go over why doing this makes sense at this point in time. So if you look over at my chart here, this is Ethereum versus the US dollar. And like I told you, when you're yield farming, at least with the strategy that we're going to be doing, we are putting trading pairs onto decentralized exchanges so that when people trade back and forth between those pairs, we make the trading fees. So in this case, we're going to be talking about trading back and forth between Ethereum and the US dollar. So if we look at this chart here, this is a day chart, meaning each candle represents a day. We can see that it's just been going sideways. You know, the market's only doing three things. It's either in an uptrend, creating higher highs and higher lows, and a downtrend, creating lower highs and lower lows, or consolidating, which is chopping sideways, which is what it's doing right now. So if the market is chopping sideways, and to be honest, I feel like we're going to chop sideways for a while. You know, we have the Federal Reserve raising the interest rates. A fun fact, we have never seen a market bottom while the Federal Reserve was still raising rates. So if they're trying to get inflation to 2% and we just came in at 8.1%, that tells you they're going to be raising rates until that inflation starts to come down. And, you know, ETH 2.0 already happened. The halving is, you know, another 2 years out or so. We're still in a war with Ukraine. And we just came off of the 2 years where we printed the most money in history. There isn't any catalyst to make me short-term bullish on crypto. So my thesis is that I think we're going to at least drop back down to this $1,000 level. Probably lower, hopefully lower, because I'm short in Bitcoin and ETH. And I think we're going to be inside of this white box for the next 6 months to a year. So if I think that, I want to be able to make money when the market is in that zone. And I'm going to show you how. So if you look at my chart here, these are my liquidity providing zones, meaning the decentralized exchange that I'm going to be providing liquidity on is going to be Uniswap. I'll get into what Uniswap is and why I'm using Uniswap in a second, but bear with me here. So this white box, I'm providing my liquidity within the range of 1,004, pretty much 1,000 and 2,000. So whenever price is between 1,000 and 2,000, I'm making money, and also between 1,400 and 1,800. So as you can see, it just went out of range. And what I'm going to do with you guys live here today is set up the range between 1,000 and 1,400. So I think we're going to be, the market likes to operate between support and resistance, ceilings and floors. So I think we're going to be between this white box for, you know, the next few months. So I want to make money while we're in here. But I also want to, you know, be able to make higher money. So I'm casting a few wider nets here. So I make money when it's between 1,000 and 2,000, and when it's between 1,400 and 1,800, and when it's between 1,400 and 1,000. And the tighter your range, the more you make, the higher your APR. Okay, and that also means when you go out of range, like right now, my position from 1,800 to 1,400 is out of range. As you can see, we're at 13.8. It looks like we're about to retest this and keep making our way down. Now I'm out of range. So I want to set it up to where I have a few nets out there casted into the ocean so that whenever the market goes within my net, I'm making money, okay? So you might be asking yourself, well, the question you should be asking yourself, would I have just made more money had I held ETH through this time? So I've been in this range. I've been providing liquidity within this orange box literally since it got in here. So around July 19th. Like, would you have made more money if you would have just held the two assets? Let's take a look. So if you go over to DeFi Labs at XYZ, it's a Uniswap V3 calculator, and you can kind of use it to backtest how much money you would have made in the past 30 days based on the positions you had. So I just told you guys, I'm providing liquidity from 1,000 to 2,000. So if you look here in the past 30 days, hodling means hold on for dear life. That's what I would have made had I just held it in my wallet. Held half USDC and half ETH. The blue line is if I would have provided liquidity within the range that I just showed you guys, 2,000 and 1,000. So as you can see, strategy one is me providing liquidity, which is this blue line, and hodling is this brown line. So as you can see here, had I just hodled, I would have lost 5.5%. But given that I provided liquidity, I only lost 2.5%. It literally saved me around 50% of my losses. And keep in mind, I am generating these fees as long as it's in the range. So I can claim those fees when the market dips or when I get out of range, and I can use those fees to buy the dip. So now when things go back up, the disparity on this chart is going to be even larger, but in a good way. Okay, so there you're probably asking yourself now, like, there are so many decentralized exchanges out there. Why Uniswap? 3 reasons. The first one is because I told you we're making money off of trading volume. So we want to go where most of the volume is. So if you look at my screen here, I'm on DeFiLlama.com. You can look at all the decentralized exchanges across all of the different blockchains, or the main blockchains. And as you can see here, Uniswap has the most volume. And by far, in the past month, volume has dropped 66% on Uniswap, but on its closest competitor, PancakeSwap, it's dropped 40%. And the 24-hour volume is still way higher. You know, in the past 24 hours, $591 million in trading volume went through Uniswap versus $168 million on SushiSwap. And Uniswap makes up for almost 60% of all of the DEX volume in all of crypto. So that's a really important thing. And just so you know, I'm doing it on Polygon because gas fees. So yes, gas fees have been a lot cheaper on Ethereum lately due to the lack of activity, but we're in a bear market. There's, a couple of billionaires on my network are telling me of projects that's just sitting there collecting dust, waiting to launch until market conditions are to their liking. So once the market starts to pick up, or any day now, someone can drop a project on Ethereum and take up a lot of block space, and now gas fees are going to go up, and those gas fees affect your profits when you're yield farming as well. Someone can launch on Polygon and the fees are still going to stay pretty cheap. And Polygon, as you can see here, they still have a lot of volume on here, $126 million in trading volume. Okay, so that's the first reason why I'm doing Uniswap V3. Now, how does that translate to you making money? Yeah, the volume is high, but how are you making more money? I'm going to show you this right now. So if you look at my screen here, out of all of the crypto applications, including layer 1 blockchains like Ethereum, Avalanche, Cardano, this website shows the platforms or blockchains, just crypto projects, period, that people are paying the most fees to use. And if we look here, under Ethereum, people are paying more money to use Uniswap than any other application, than the whole Binance Smart Chain, GMX, Aave, even Bitcoin fees. Literally, per day, people are paying $751 million in fees. And on 7 days, every 7 days on average, people are paying $1.2 billion in fees to use Uniswap. Now, I just told you, we are acting as a market maker on Uniswap. There aren't any, Citadels or Fidelities, providing trading pairs on Uniswap. It's everyday people like you and I. So that means that given that we're the market makers and we're paying the fees, or we're making the fees, that means this $751 million, like, let's say you provided 10% of all the liquidity used on Uniswap. Well, guess what? That means you make 10% of the fees, because you're going to get paid in fees whatever your percentage of that pool is. So if it's $100,000 in a pool of ETHUSDC and you have 5K in ETH, 5K in USDC, you're going to make 10% of the trading fees, since your capital makes up 10% of the pool. Hopefully that makes sense. And the third reason, and the most important reason, to be honest, why I'm using Uniswap over any decentralized exchange is because they have a feature that's called concentrated liquidity. And the concentrated liquidity feature, I've already been talking about it in this video, is the feature that allows you to say, hey, I only want my liquidity being used once price is within this range. So before concentrated liquidity launched, you had just a traditional automated market maker, and it bunched everyone's liquidity into a giant pool. And that was inefficient because you weren't able to outperform what's called impermanent loss. I'm going to dive into what impermanent loss is in a bit. But basically, concentrated liquidity gives you better control over when your capital is used. And that's important because if you just provided liquidity in the traditional way, there's going to be a lot of times where your capital isn't used and it's literally just sitting there. Not just sitting there, but you can actually be losing money. And a lot of people were. And that's why Uniswap launched this concentrated liquidity. So before I show you proof of this, let me explain what impermanent loss is. So when you provide liquidity for a decentralized exchange to use to trade back and forth with, in a traditional sense, you have to put equal amounts of assets in the pool. So if this wasn't concentrated liquidity and you were providing liquidity for Ethereum and USDC, and let's say you're doing 10,000 total, 5,000 in Ethereum, $5,000 in USDC, this is what happens. Let's say the price of ETH goes up. Well, given that this is a traditional AMM, in order to keep that liquidity position balanced, when the price of Ethereum goes up, it's going to be selling off, like this is Ethereum. Ethereum's going up, it's going to be selling off Ethereum, buying more US dollars for you to keep it balanced. And the same thing on the way down. It's pretty much a limit order for the loser. When Ethereum starts to go down, it's going to start selling off USDC to buy more ETH to keep it balanced, okay? So let me show you what this looks like here on the calculator. Now, let's say this is I did these numbers to represent Ethereum and USDC just to keep it simple, but you can use this calculator if you're providing liquidity for Ethereum and Bitcoin, Ethereum and Matic, whatever two tokens, you just put the price in here. So let's say Ethereum is a $1,000, just for example's sake, and you put 10 of them in here. So you have 10,000 here, and then you have $10,000 in USDC. And let's say the price of Ethereum goes up 50%. So I told you it's going to be selling off ETH and buying more USDC. So now you have 8 Ethereum tokens instead of 10. And now you have $12,000 in USDC versus 10. And if you go down here, you have an impermanent loss of negative 2.02%. Okay, but let me explain. It shows this is your liquidity factoring in the impermanent loss, and this is your total value had you just held. You're probably thinking to yourself, well, why would I provide liquidity if I lost money? This isn't factoring in your APR or the fees that you would get paid. So let's say your APR is 100%. That means your real yield is 98%, because you want to take your APR and subtract your impermanent loss to get the real yield. And it's the same thing in the traditional financial sector. If you're invested into a government bond, if the yield on it is 3%, but inflation is 5%, then you actually have a negative 2% real yield, because you have to subtract the inflation from your real yield. So here you have to subtract your impermanent loss from your real yield. So that's the price if it were to go up. Now let's say Ethereum drops 50%. Well, hey, remember when I told you it's going to be buying more ETH. So now you're going to have 14 ETH instead of 10, and you're going to have $7,000 worth of USDC instead of 10. And now when you go down here, you have an impermanent loss of negative 5.72%. But same thing, you can yield farm. Your yield farming works when people are trading and the price is going down, and when it's trading and the price is going up. Just as long as it's within whatever zone you chose. So now let me explain how impermanent loss works with Uniswap V3, because it's not the same. So let's say I'm providing liquidity within $1,400 to $1,800, okay? If the price goes out of range to the downside, and when I say out of range, I mean outside of the zone that I'm in, now I'm in 100% ETH. So since ETH is the asset that was going down, the smart contract is going to buy me 100% ETH. So now that I'm out of range on this position, I'm in 100% ETH. But if it goes out of range to the upside, I'm going to be in 100% USDC, okay? So now this is a good segue into risk management. You only want to pair two assets to yield farm that you don't mind holding either of them. So I don't mind holding USDC because it's dry powder I can use to buy the dip. And I don't mind holding all ETH because I'm bullish on ETH. I feel like it's going to be around in the next 10, 20, 30 years. Another thing, only invest what you're willing to lose. Like, these protocols are very new. Uniswap, yes, has been battle tested. It's never been hacked. It has the highest amount of volume and liquidity, TVL, etc., etc. But you still only want to invest what you're willing to use. Don't put the whole farm in here. And the last thing, and might be the most important thing, you want to start small so you can get the hang of this thing. You don't just ape in. I know you're excited about making the passive income. I love logging onto my computer, checking my farms, but I lost money in the beginning because I had to figure it out. Now I'm an expert at it and I know what I'm doing, but you always want to start small, because if you make a mistake, it's better to make a mistake with an amount that you can bounce back from. You don't want to put the whole thing in there, make a mistake, and now you have a bad taste in your mouth when it comes to concentrated liquidity, and now you just missed out on the opportunity because you started too big. Like, start small so that if something happens, you can bounce back. One more thing I wanted to show you. I told you guys that concentrated liquidity is more capital efficient, aka it makes you more money than just using your liquidity for an unlimited range. And I'm going to prove that to you here. So if you look at my screen here, strategy 1 is concentrated liquidity between $1,000 and $2,000. And unbounded just means, hey, use my liquidity for whatever the price of Ethereum is in. So if you see here, with strategy 1, in the past 30 days, it's been in range the whole time. However, and this is with only investing $1,000. So keep that in mind. So through investing $1,000 in a month, if I would have used concentrated liquidity, I would have made $36.07. If I would have did unbounded, I would have made $5.83. Okay? And my return would have been a negative 3.418%, because remember, ETH is dropping. But if I would have did unbounded, my losses would have been almost double, at negative 6.148%. My APR would have been 44.63%. And unbounded, it would have been 7.09%. So that's proof that concentrated liquidity is way more efficient than just the regular automated market maker. So now that we've went over that, I'm going to show you guys some live farms, and I'm going to set up a farm right here with you, and I'm going to show you how to track it. All right, so here we are on uniswap.org. We're going to hit new position. We're going to select wrapped ETH and USDC. It's going to automatically pick our fee tier. Remember, I said I wanted to do 1,400 to 1,000. So my minimum is 1,000, meaning, hey, if price dips below 1,000, don't use my liquidity. And if price gets above 1,400, don't use my liquidity. So now, okay, so this is another important thing. So you see that this is my range here, this white line and this orange box. So given that we're at the top of this range, I'm going to have to provide pretty much 90% of the capital is going to be in USDC, since it's at the top. If I wanted to provide an even amount, I would have to do it when it was at the price of around 1,182. But since it's at the top, it's requiring me to put in more USDC. Remember, because it has to be, I'm not going to say balance, but it has to have enough to where it can use my liquidity if it goes down. So just keep that in mind. So now here we are back. I'm going to hit max USDC. You'll have to do the math. You're going to hit preview. I'm going to hit add. So now that we have our farm set up, let's go over how we track the darn results, because that's what's important. So we're going to head over to revert.finance. We're going to connect our wallet. And then this gives you all the data on your Uniswap V3 position. So let's look at a few of my farms. So, you know, the market has been dropping. This farm was actually paying out like around 150% a week ago. So even with prices going down, I've been in this position for 121 days. I've made $4 grand. And just so you know, this is my wide range farming wallet. If you want to see my strategy on how I'm making the most money, you have to click the Google form link to request to join our Discord. We're only letting a certain amount of people in, and our course is going to go over all the yield farming strategies that you need to know to generate the highest amount of passive income. I'm just giving you guys the tip of the iceberg here. If we go over my Radix and Wrapped ETH farm, I've been in this position for what, half a year now, 173 days, made over $6 grand. That's factoring in the market dropping and then USDC wrapped ETH. So I'm getting 44% on one. I'm getting 69% on one. This is the one I just set up. So if there is a lag, like obviously I haven't made any money yet because I literally just set it up like 2 minutes ago. And then this one's out of range. There's a lag on this one. This isn't like the actual data. So you're gonna want to track this on your own as well, but this gives you like a great idea. Yield farming is a passive income opportunity. It's the best way to make passive income in the history of the world. There's never been a time where we can act as a market maker or help facilitate borrowing and lending and act as a bank. There's going to be times when your position goes out of range. So the ranges you pick should be determined by how much time you have to monitor your farms. Now, obviously, none of this is financial advice. Consult with your own financial advisor before doing any of these strategies. This is just for your education purposes only. So if you want to learn the best way to yield farm, you want to get access to the strategies we're using to literally print money day and night, click the Google form in the description to get a link to get into our Discord, where we will be releasing our course and we'll be going over all these strategies. I'm just giving you guys the tip of the iceberg here. The tighter you make your ranges, the more money it's going to make you, because it's using your capital more because it's within a smaller range. So the less time you have to allocate it, the wider your range should be. And obviously I'm able to make over $1,000 per day because I'm playing with six figures. But there are other ways that we go over within our group that I'm also going to be going over within the course that we drop in the next coming weeks. So if this sounds interesting to you, click the link in the description, click the Google form so you can apply to get in our Discord, and be on the lookout for our course. It's going to be the best yield farming alpha group in the world, and I know because I've been through all of them. We're literally going to be showing people how to print money all day, every day, no matter what you're doing. So with that, I thank you guys for tuning in. I strongly ask you to consider hitting that like, comment, subscribe button, as it really helps the channel. We're trying to bootstrap this from zero. And I'll see you in the next video. Take care.